Welcome to the Deep Dive, the only show that takes a massive stack of research and cuts straight to the core insights you actually need.
That's us.
Today, we are opening the playbooks of a truly fascinating and mostly unknown group of market wizards. We're talking about 6 futures traders.
Yeah, their performance metrics, they're pretty stellar, but they haven't really been widely publicized. And their results, well, they really challenge the idea that success in futures is just, random luck.
Exactly. Our mission today isn't just about what they trade, but really digging into how they built their methodologies.
Right. We're synthesizing the unique approaches, the performance profiles, and maybe most importantly, the psychological side of things for Peter Brandt, Jason Shapiro, Richard Barg, Amrit Sal, Diljit Dalwal, and John Netto.
We're looking for that secret sauce, that non-random element.
You got it.
And what jumps out right away is these aren't guys just following some standard technical indicator from a book.
No, not at all. They each have these completely individualized systems, stuff they've refined over decades, often built on the back of some pretty big failures, actually.
Right. And the common thread seems to be this almost fanatical dedication to process and a really high level of self-awareness. It lets them deliberately override their own sort of natural human instincts.
Which are often the destructive ones in trading.
Exactly. So today, we're diving deep into the operational mechanics, how they define risk, how they manage it, the unique edges they found in these super competitive markets.
And that huge piece, mastering the psychological game. We're looking at a whole spectrum here. You've got Brandt's methodical chart discipline on one end, and maybe Sal's high-speed event-driven trading on the other. But the core theme, whatever the style, it's this unwavering commitment to a predefined process. That comes first.
Okay, let's unpack this. Let's start with 2 traders who really exemplified disciplined execution and having those exits planned way ahead. Peter Brandt and John Netto.
Sounds good.
Peter Brandt. Now, he's a name a lot of technical analysts know, but it's his actual performance metrics, how he made his money, that really make him stand out.
Yeah, the first thing you really notice, the thing that grabs your attention, is the big difference between his Sharpe ratio and his adjusted Sortino ratio.
Okay.
His Sharpe was 1.11, which, for long-term trading, that's respectable. But his adjusted Sortino ratio, almost 3 times higher, came in at 3.0. That gap, that disparity is really key to understanding why he was successful.
Okay, so for listeners who maybe aren't deep in finance terms every day, let's break that down. Why does that difference, that gap, actually matter so much when we're talking about successful trading?
Well, it's kind of everything, because it tells us about the shape of his returns. You see, the standard Sharpe ratio, it penalizes all volatility the same. Doesn't matter if it's a scary loss or a huge gain, it likes smooth, consistent returns.
Right, it punishes bumps in the road, up or down.
Exactly. But the Sortino ratio, it only cares about the downside volatility. The bumps going down below, say, the risk-free rate or 0.
Okay. So a much higher Sortino compared to a decent Sharpe means his performance wasn't necessarily smooth.
Not at all.
But when the volatility did hit, it was overwhelmingly on the upside. Big positive swings.
Precisely. That 3.00 versus 1.11, it's like the mathematical proof. Brandt kept his losses incredibly tight, very contained, but he generated these large, sort of sporadic, huge gains.
So his returns are positively skewed. More chance of a massive win than a massive loss.
That's it. It proves he's a trader who makes his money in big, infrequent chunks. Yeah. But those inevitable small losses, the ones he calls popcorn trades, they stay small. Insignificant, really.
And he manages this by, basically taking himself out of the immediate decision loop, right? He calls himself a glorified order enterer.
Yeah, and that's intentional self-awareness. It's what makes him successful. He says point blank, if he just traded off the screen, followed his gut, he'd blow up. So his whole success hinges on creating this predefined process, something so solid that it overrides his natural impulses. He trades the plan, not the flashing price on the screen.
Let's get into that discipline a bit more. He doesn't really trade Monday to Friday based on what he's seeing in real time, does he?
No, not really. His schedule is, it's pretty counterintuitive for most people. He does all his heavy lifting, the chart analysis, figuring out new positions, setting exact entry, exit, stop points. He does all that only when the markets are closed.
Like over the weekend?
Specifically, yeah.
Yeah.
Between the Friday close and the Sunday evening open. Then, during the actual trading week, he deliberately avoids watching the screen too closely. It's like a self-imposed quarantine. And it's critical for him.
But wait, how does avoiding the screen help? Wouldn't he risk missing, like, a sudden market move or some important news?
He accepts that risk because the alternative for him is worse. Watching the screen all week, it just introduces temptation, right?
Yeah, you see something moving.
Exactly. You jump the gun, you chase a rally, you panic out of a perfectly good position, or, maybe worst of all, you override your carefully made plan just because of some intra-week noise.
So by only executing based on the weekend work, the decision's already baked in.
Right. It removes the emotional heat of the moment. The decision's already made in the calm of the weekend.
And when he does put on a trade, his risk rules are super strict, like risking only 0.5% of his capital initially.
Yeah, 0.5%.
Tiny. Aiming for a 2% target. That's a 4-to-1 risk reward built right in.
And sticking to that risk-reward setup, that's what defines a good trade for him, not whether it won or lost money.
Right.
If he followed the plan, the 0.5% risk, the preset exit, was a good trade, period. End of story.
That must make it easier to handle all the small losses that come with pattern trading.
Absolutely. It allows him to tolerate them because he knows his system needs those many small, quick losses to find the few massive winners that pay for everything. And interestingly, he notes those huge winners often felt the most counterintuitive or difficult to actually pull the trigger on.
He's also really strict about managing profits once he has them. He talks about avoiding giving back gains, these popcorn trades.
Yeah, this is where that mechanical rigidity comes back.
Right.
Once a position gets to 70% of his target, say, it's up $1,800 on a $2,000 target.
Okay.
His automatic 3-day stop rule just kicks in. Boom. It aggressively tightens the stop loss. It's automatic. It's rigid because he hates indecision, especially when he's sitting on a good profit.
So he's basically saying, look, I'm not going to risk giving back this $1,800 just for a shot at the last $200. The process locks in the bulk of it.
Exactly. It reinforces that positive skew in his returns. He accepts, yeah, sometimes the market might rip straight through the 100% target and keep going, but he prioritizes the certainty of banking the vast majority of the game. It's like playing defense when you've got a big lead.
And for his technical analysis, he uses this great analogy, the ice line. How does that work? How do you get from a frozen lake to a futures chart?
It's a really good visual for understanding, like, the psychology shifts in the market. Imagine you live on a frozen lake, right? That ice, it's resistance. You can't go through it easily.
Okay.
But once the pressure builds, maybe the ice cracks and you fall through. Now you're in the water. It's a totally new environment. But that ice, looking up from underneath, now it's really strong support.
Ah, I see. So the old resistance becomes new support once it's broken.
Exactly. On a chart, that ice line is a critical resistance or support level. Once it's definitively broken, that signals a strong potential breakout.
Can you give us a concrete example?
Yeah.
Say S&P futures. How would he use the low of the entry day bar with this?
Sure. Let's say the S&P E-mini futures, they just haven't been able to crack $5,000 for wicks.
Yeah.
That's your ice line, right? Resistance.
Got it.
Then maybe Monday morning, bang, price breakthrough decisively. Trades up to, say, $5,010. Brand might get long around $5,005.
Okay.
Now, his stop loss, based on this ice line idea, goes immediately just below the low of that breakout bar. Let's say the low of the day so far was $4,998. Stop goes right there.
They're super tight.
Incredibly tight. He knows he'll probably get stopped out a bunch if it's a false breakout. But by putting the stop just below that key prior level, he's testing his breakout idea with the absolute minimum risk. If the price falls back below $5,000, back into the old range.
His idea is instantly wrong.
Instantly disproven. He takes the small, fast loss, preserves his capital, and waits for the next clean setup, no messing around.
Okay, that sets up a nice contrast with John Netto. He also emphasizes process, like Brandt, but he's operating in a totally different space. High-speed, event-driven trading.
Yeah, Netto's approach is, it's a real synthesis. He's not just a technical guy, not just a fundamentals guy. He first builds this understanding of the main fundamental story, the market narrative, the bias.
So, like, is the Fed hawkish or dovish overall, that kind of thing?
Exactly. But then he uses technical analysis strictly to pinpoint the best entry points, usually right at key support or resistance levels.
So the fundamentals tell him which way the wind is blowing, but the charts tell him exactly where to stand to catch it.
That's a great way to put it, yeah.
Yeah.
This blend means he's trading with the underlying flow, but he demands that precise execution to maximize his risk reward.
Makes sense.
But where he really gets his edge, his unique thing, is the intense preparation he does for scheduled events. Think Fed statements, ECB announcements, times when the market can move incredibly fast, like fractions of a second.
Yeah, this sounds like an infrastructure edge almost. He's not just reading the news release, he's got a whole framework ready.
His prep is, well, obsessive is probably the right word. Before a big event, he maps out dozens of possible scenarios. Scenario A, hawkish Fed. Scenario B, dovish. Scenario C, neutral. And then all the little variations based on specific words or phrases they might use.
Wow.
And then he uses his own proprietary software called Empath-CT.
Okay, Empath. Let's peek under the hood there. Is it basically like automated trading based on keywords in the news release?
It's more sophisticated than just keyword spotting, but yeah, speed is the core idea.
Yeah.
Empath-CT stands for market pricing condition trading. It's basically a pre-programmed execution system.
Right.
The instant the news hits the wire, Neto uses his deep fundamental knowledge to immediately figure out which of his dozens of pre-planned scenarios is actually happening. His system then lets him execute almost instantly, like a fraction of a second, to grab the immediate mispricing before the slower algos or human traders can even process the news.
So he's not predicting the news itself?
No, not at all. It's about being instantly ready to capitalize on the market's reaction to the news, whatever it is.
That really highlights the huge learning curve, though. You mentioned he lost $210,000 in one day back in 2017.
Yeah.
Because he missed a couple of key dovish elements in a statement. So even with fancy software, the human reading and interpretation is still the critical bottleneck.
That loss was huge for him, formative. It taught him that mapping out scenarios isn't just mechanical. It requires this really deep understanding of central bank language, economic nuances. Missing those dovish bits meant he read the market reaction wrong, traded the wrong preset scenario.
And the system's speed just magnified the error.
Exactly. It proved the tech is only as good as the human analysis setting up the scenarios beforehand.
Yet, maybe the most contrarian thing about Neto is his view on emotions. He sees them as a friend, not an enemy to be suppressed, which goes against what most traders try to do.
Yeah, this is a really interesting, sophisticated way to frame it. Neto gets that emotions, the fear, the greed, the anxiety generated by market action, they're natural signals. The trick is managing them with strict process.
How does that work in practice?
Okay, say he puts on a trade, and suddenly he feels this huge wave of fear or intense self-doubt. Instead of fighting it, he uses that feeling as data. It suggests the rest of the market, the herd, is probably feeling that same stress.
So if a trade feels really uncomfortable,
that often means it's contrarian, and potentially the right trade. The discomfort can actually be a confirmation signal for his contrarian ideas.
But how does he stop that emotional signal from just taking over? From making him panic and dump the trade or violate his risk rules?
That's the key. The process controls the action. The emotion only informs the idea. If the market churn makes him anxious, okay, that might reinforce the contrarian idea. But his preset process immediately dictates the maximum size he can trade and the absolute non-negotiable exit point.
So he turns anxiety into just another data point instead of letting it drive the bus.
Exactly. He validates the trade concept with the emotion, but he doesn't let the emotion dictate the risk he takes. The process handles the risk.
And you can see how sustaining that level of intensity, that kind of analysis and emotional management, requires real passion. He famously said, "I am successful because Monday is my favorite day of the week."
Yeah, that love of the game, it feels essential for someone operating at his intensity level. Without that deep, genuine enthusiasm, the sheer workload, prepping all those scenarios, he was even going to law school at night while doing this, running this high-stakes trading operation. It just wouldn't be sustainable psychologically. That discipline required to manage the emotional signals, it has to be fueled by a real passion for the puzzle itself.
Okay, so if part A was largely about imposing this kind of external rigid process on trading, part 2 shows us traders who found their edge more by looking inward, understanding market dislocations, and crucially, their own emotional failings. We kick this off with Jason Shapiro, who basically only found success when he systematized being a contrarian.
Shapiro's story is, it's the ultimate turnaround. He spent his early years just blowing up accounts because he followed his gut instinct.
Like most people start out.
Exactly. He'd either assume a bull market would go on forever, or he'd fight a strong trend way too long. His success, and he's been doing this for over 30 years now, it really started when he had this insight. His own natural emotional reactions were perfectly aligned with the losing side of the market.
Ouch. That's a tough realization.
Yeah, but powerful. He realized his winning methodology had to be quite literally the opposite of whatever his first instinct was.
So he figured out how to profit from his own history of messing up. How does he actually do that? How do you operationalize being the opposite?
Well, his mechanics really stand on two legs. First, he identifies extremes in speculator positioning. For this, he uses the weekly commitment of traders report, the COT data.
Okay, the COT report.
Second, he times his actual entry based on price action. He looks for specific chart reversals, even when, and this is key, even when the news flow is overwhelmingly pointing the other way.
Right, let's unpack that COT report bit. For anyone not familiar, what's the specific signal in there that Shapiro keys off of?
So the COT report, it breaks down positions held by different groups. Commercial hedgers, think farmers, airlines, big companies using futures to hedge real-world risk.
Right, the smart money sometimes.
Often, yeah. Then you have non-commercial traders. These are the large speculators, hedge funds, money managers. And then the non-reportables, the small retail traders. Shapiro focuses almost entirely on the non-commercials, the large specs.
Why them specifically?
Because these are generally the trend followers, the momentum players. And they tend to get way, way overextended, totally saturated, right at major market tops and bottoms.
And the thinking is, if the speculators are, say, 90% net short, just massively bearish, there's basically no one left to sell. The selling is exhausted.
That's exactly it. The trade is just wrung out of speculative participation, and this leads right into his participation theory. Shapiro argues markets don't just top or bottom because prices have discounted all the news. They turn because speculative positioning has hit a saturation point. A market can bottom on absolutely terrible bearish news, precisely because every speculator who could sell short is already short. They've all participated. There's only buying pressure left, mainly from them covering shorts.
That's a really critical distinction. It's not waiting for good news. It's waiting for the last seller to throw in the towel.
It's totally about positioning and who's left to act. It's about liquidity. And often, the commercial hedgers, who are usually on the opposite side of the large specs at these extremes, they provide that key buying at bottoms or selling at tops. Shapiro is essentially siding with the informed hedgers right when the momentum crowd hits peak emotion.
He also used a fascinating human proxy to double-check his contrarian signals, right? A colleague who was always bearish.
Yeah, this is a brilliant example of turning self-awareness into a trading tool. He had this former colleague, James Vandell, who was just perpetually pessimistic. Shapiro realized that James's extreme views, whether super bearish or, on rare occasions, surprisingly bullish, perfectly mirrored Shapiro's own losing tendencies from his early days.
Wow.
So when James was at his absolute most convinced about something, Shapiro would take that as a strong signal to seriously consider the opposite trade. Especially if the COT data was maybe a bit borderline.
Sure.
He literally profited by seeing the patterns of his own past failures playing out in someone else.
That takes incredible humility and discipline. And the importance of patience in this kind of contrarian strategy, it's perfectly shown by that Africa lesson story.
Oh yeah, the Africa lesson. It should be required reading for any discretionary trader. Early in his career, Shapiro goes on this 3-week trip to Africa. No way to monitor his positions, no internet, nothing.
Forced detachment.
Totally. When he gets back, the one position he left on had racked up this huge profit, way more than he thinks he would have made if he'd been watching it every day.
Because he would have snatched the profit early?
Exactly. He realized the constant temptation to take profits too soon, driven by watching the daily noise and feeling anxious, was actually killing his overall results.
So the lesson was, these COT reversal trades, they often need time. You have to hold through weeks, maybe months of market chop until that sentiment really turns. Watching it daily just makes you jumpy.
Absolutely. Markets rarely go straight up or down. True reversals need patience to absorb those minor counter-trend moves without hitting the panic button. Being forced away proved his initial analysis was often right, but his day-to-day fiddling was toxic to the outcome.
But even with this very discretionary, sentiment-based approach, he has one rule that's completely non-negotiable: the stop loss.
It's his lifeline. Remember, he blew up twice early on because he didn't manage risk. He hammers this point home. You must have a stop on every single position. And crucially, it's placed at a point that fundamentally disproves his contrarian thesis.
Not just where the loss feels painful, but where the market itself says, nope, your idea is wrong.
Precisely. That absolute stop is what prevents one bad idea, one stubborn contrarian bet that goes wrong, from wiping out his account.
Okay, shifting gears a bit, let's turn to Daljit Dhaliwal, another macro trader, but his focus is really on meticulously defining and then sticking to his very specific edge.
Yeah, Dhaliwal's journey, it started with technical analysis like many do, but he pivoted pretty quickly. He just didn't have deep conviction in technicals alone. He felt he didn't fundamentally get why they should work consistently over time.
That's some serious intellectual honesty.
It is, and it led him to focus on macroeconomic fundamentals as the main driver for his trading ideas. He still uses technicals, but only for timing the entry and exit points, much like Neto, actually. But Dhaliwal's focus is more on longer-term macro themes.
And the really critical step he took was actively studying his own trading history, especially his biggest winning trades, to figure out precisely what his edge was. What were the common factors he found?
He boiled it down to 3 key characteristics that had to be there for him to have high conviction in a trade. First, the trade was usually kicked off by some kind of completely unexpected event. Not just scheduled news, but a real surprise.
Okay, a catalyst.
Second, there had to be harmony between his short-term view and his long-term macro view. The trade needed to make sense on multiple timeframes.
Right.
And third, and this is really interesting, the trade had to start working immediately after he put it on. If it just sat there or went against him right away, that was often a sign of a flawed idea or maybe just bad timing.
That third point, the immediate entry work, that's fascinating. So if the market doesn't validate his macro thesis pretty much instantly, he's inclined to just get out. Avoids tying up capital.
It's like an efficiency check for his ideas. He realized his best trades, the really big ones, they often required very little hand-holding. They just worked from the get-go. If a trade needs a lot of patience just to get back to break even, it's probably marginal. It's tying up mental energy and financial capital that could be used elsewhere.
And the self-awareness is crucial, right? If you can't clearly say what your edge is.
And you probably don't have a reliable one.
Yeah. His core principle is also wonderfully pragmatic, maybe tough for some traders to swallow. I want to make money more than I want to be right.
This is like the ultimate ego defense mechanism in trading. Trying to be intellectually correct, proving your complex thesis was right. That's a huge trap. Dhaliwal forces himself to prioritize actual profitability over just being smart or validating his analysis.
Which means he has to actively look for signs he might be wrong.
Exactly. He actively searches for disconfirming signals, which is hard. When you've got money riding on an idea, your natural bias is to look for evidence that confirms you're right. He fights that instinct. He demands proof that he might be wrong.
How does someone actually do that?
Yeah.
How do you genuinely look for reasons you're wrong when you're convinced you're right?
It has to be structured. He basically interrogates his own premise. Before he even puts the trade on, he asks himself, okay, what specific data point or what price action, if it happened right now, would make me completely abandon this idea?
Defining the kill conditions up front.
Precisely. He makes a list of potential macro surprises or technical levels that would invalidate his thesis before the trade is live. That way, there's no emotional negotiation later. If X happens, the rule says get out. No second guessing, even if the price hasn't hit his formal stop loss yet.
He also uses a very systematic, layered approach to cutting risk when he hits a losing streak. He accepts drawdowns are part of the game, but he controls the damage.
Yeah, this is textbook professional risk management. He basically says any loss under 5% of his capital, that's just market noise, normal fluctuations.
Okay.
But as soon as the drawdown hits 5%, bang, he cuts his standard position size in half. Immediately.
50% cut.
Wow. If the drawdown gets worse, it's 8%. He cuts size by half again. So now he's trading at only 25% of his normal size. And if things really go south and the drawdown reaches 15%, he stops trading completely. Full stop. Takes a mandatory break.
That sounds almost severe, but you can see how it prevents a bad run, which every trader has, from turning into a total disaster.
Exactly. It's built on the recognition that if your system is spitting out repeated, significant losses, something's wrong. Either you're mentally off kilter, or maybe the market regime has shifted against your edge. Cutting size buys you time, reduces the financial pain, and forces you to step back and analyze what's going on before you risk big money again.
And like pretty much every successful trader we look at, he learned the absolute necessity of strict risk controls the hard way.
Yeah, Dhaliwal tells this story of a massive loss he took because of an incorrect Financial Times story about the ECB. It moved the market violently, instantly. And crucially, his loss was much bigger than it should have been because in that specific moment, he didn't have a protective stop-loss order in place. It cemented the lesson for him. Even if your macro analysis is spot on, you're always vulnerable to random events, black swans, bad reporting, system failures, geopolitical shocks. They can hit without warning. You must have those immediate protective risk controls in place at all times. Otherwise, all the sophisticated analysis in the world is useless.
All right, moving into our final section now, we're really zoning in on the mental game. Starting with Richard Barg, who actually put mindset even above technical skill in importance.
Yeah, Barg's view is really that trading success is fundamentally a psychological game. The technicals, the fundamentals, they support that game, but they aren't the main event.
Interesting.
He proactively focused on being mentally right and just plain happy as like a non-negotiable requirement before he could even think about trading successfully. He recognized the huge mental toll this profession takes, the high stakes, the instant feedback loop.
Yeah.
If your head isn't straight, your system, no matter how good, just won't work.
But what does mentally right actually mean in practice? Was he meditating, or did he have some specific routine?
It seemed to be pretty holistic for him. Yes, physical health mattered, diet, exercise, but also maintaining emotional balance outside of trading hours. If he came into the trading day feeling stressed about a personal issue or worried about finances unrelated to his trading capital, he'd either trade much smaller size, dramatically smaller, or sometimes just not trade at all that day. He actively tried to minimize external stress so that the inevitable market volatility wouldn't push him over his psychological edge.
He also shared a really important lesson about telling the difference between just a losing trade and an actual bad decision. That's something a lot of traders struggle with.
Oh yeah, the story he tells here is powerful because it involves pure luck saving him from what should have been a disaster. He was holding this huge losing position, way past the point where his rule said he should have cut it. He just froze, couldn't bring himself to take the loss. Right.
He got lucky.
The market had this brief, unexpected recovery, and it allowed him to get out with only a moderate loss instead of a potentially account-crippling one.
So the outcome was, okay, he survived the trade, but the process was terrifyingly flawed.
Exactly. That was the lesson. He realized the decision, or rather the inability to make the decision. That psychological paralysis, failing to follow his own rules, was terrible. It could have wiped him out. It taught him. A good outcome never justifies a bad trading decision. He had to separate the P&L result from whether he followed his process. If the process was broken, like not being able to hit the sell button.
The trade was bad, even if he accidentally made money or got bailed out.
Precisely. Process over outcome.
Barg also found something else interesting. That missing a potential massive win could actually be more painful and maybe more damaging long-term than taking an actual loss. The example being the Swiss National Bank dropping the currency peg.
Yeah, that 2015 S&B event was seismic. They suddenly abandoned the Euro-Swiss franc currency peg, and currency pairs moved thousands of pips in minutes. Just insane volatility. Barg missed the entire move because he happened to be out of the office for like one crucial hour. The feeling of regret, realizing he'd missed one of the best, highest probability, high volatility trading opportunities of his entire career, simply because he wasn't there. That was a major psychological blow, more painful than many actual losing trades.
And that regret actually shaped his philosophy on exiting trades, right? He started advocating for cutting lagging positions even before they hit a formal stop loss.
Yeah, his argument became that the mental capital and the financial capital you save by getting out of sluggish, non-performing trades early, that saving outweighs the small potential profit you might miss out on if the trade eventually recovers. He started viewing capital as this resource that absolutely needs to be deployed efficiently. Why let it sit in a trade that's clearly struggling when you could free it up for the next better opportunity?
And this all ties back to his point about position sizing and staying within your comfort zone.
Absolutely. He really emphasized that as soon as you trade a position size that's bigger than what you're truly comfortable losing, you immediately introduce fear into the equation. And fear is just poison for decision-making in markets.
Right. Fear makes you do dumb things.
Exactly. When you're trading scared, you tend to cut your winners way too soon, just to lock in any small profit and stop the anxiety. And you hold on to your losers way too long, hoping they'll come back, because the prospect of realizing that oversized loss is too terrifying. You have to size your trade so that hitting your planned stop loss is acceptable. Annoying, maybe, but acceptable enough that you can actually execute it without freezing up.
Okay, now let's pivot to Emrit Saul. His performance numbers are just, well, they're kind of mind-bending. He definitely owned that nickname, the Unicorn Sniper.
Sal's metrics are genuinely extreme. You have to put them in context because they're such outliers. Over a 13-year stretch, his average annual compounded return was 337% annually. Compounded.
Yeah. And crucially, remember our discussion about Sortino ratios. His adjusted Sortino was 17.6. That's 12 times higher than his already decent Sharpe ratio of 1.43.
12 times. Most traders would kill for a Sortino that's maybe double their Sharpe. Exactly. A 12x ratio like that just screams incredibly contained losses, but winning trades that were just exponentially explosive. We're talking, over that period, 34 separate days where his return was over 15%. That includes 3 days where he made over 100% in a single day.
Okay, making over 100% in one day. That requires some serious leverage and volatility, right? This isn't happening in your average stock portfolio.
Oh, absolutely not. To get returns on that scale requires operating in highly leveraged markets like futures or foreign exchange, where the potential volatility combined with the margin available allows for those kinds of moves. Sure. This is pure high-conviction event sniping.
And he views himself like a sniper, right? Always ready, but waiting patiently for that perfect shot.
That's his core analogy. He sees himself perpetually ready, scanning the horizon, but most of the time, he's just waiting. He explicitly says that not trading is the difficult part.
That's counterintuitive for a lot of people who feel they need to be doing something.
Right. But he understands his edge. He knows that something like 90% of his profits come from maybe just 10% of the time, usually clustered around major predictable news events. So taking marginal trades that don't perfectly fit his strict criteria, they don't just risk money. In his words, they waste mental and financial capital.
They dull his edge for when the real opportunity appears.
Exactly. They clutter his thinking, reduce the capital he has ready for the A-plus setups. His discipline isn't just about executing trades well. It's primarily about preserving his capital and his mental readiness for those few moments each year that truly count.
Like John Netto, Sal is an event trader. But Sal often seems to make his money by going against the initial herd reaction to the news, exploiting that first immediate mispricing. Can you walk us through his famous ECB trade example?
Sure. This was during a major European central bank announcement about quantitative easing, QE. The market, the initial speculative reaction, was hyper-focused on one number: the size of the monthly asset purchases.
Okay, how much money they'd print each month.
Right. And that number came in just slightly lower than the most optimistic market expectations. So the immediate reaction, a violent sell-off in Bund futures German government bonds. The herd just instantly reacted to that single headline number being a slight disappointment.
The Sal saw something else the herd missed.
Exactly.
Yeah.
While everyone was freaking out about the monthly amount, Sal calmly read the full statement. And he keyed in on one crucial detail. The commitment to buy assets was described as open-ended.
Meaning no fixed end date for the stimulus?
Precisely. So while the monthly amount was maybe slightly less than hoped, the total amount of stimulus could be vastly larger because it wasn't time-limited. He instantly realized that the traders who sold aggressively on the headline number, the weak shorts reacting purely to disappointment, would soon have to reverse course and buy back their positions once the true implication of open-ended sank in.
So he bought into that initial panic selling, knowing the narrative would likely shift.
Yes. He exploited that immediate emotional mispricing for a massive short-term gain. He traded the implication of the full statement, not just the knee-jerk reaction to the headline number.
That takes incredible processing speed and nerve under maximum pressure.
It really does. It's about anticipating how the rest of the market will reposition once they digest the full information, not just the first soundbite. And underpinning all this, Sal maintains this incredibly powerful mindset about drawdowns.
What's his take on drawdowns? Most traders hate them.
He reframes it completely. He accepts being in a drawdown as the natural state of a trader. He compares himself to a shark, mostly just cruising underwater, unseen, waiting patiently for that big opportunity, the big meal.
So the drawdown isn't failure, it's just the waiting period.
Exactly. It totally removes the self-blame and negative spirals that cripple so many traders during losing streaks. He sees the drawdown as necessary downtime, preparation time, for the few huge winning days that make his entire year. And if he feels himself getting dragged down mentally by a losing period, he actively shifts his state by practicing gratitude, focusing on things he's thankful for, to pull his mind out of fear and panic and back into a calm, patient, ready state.
And finally, even this unicorn sniper, this outlier performer, learned the hard way about stop losses.
Yep. Even Sal wasn't immune. His conversion to using stops religiously came after his single worst trading day, a massive 24% loss. And it wasn't even a bad trade idea. It was caused by a computer failure at a critical market moment.
And he didn't have a protective stop in place.
Correct. That devastating loss, caused by something external he couldn't control, taught him the absolute necessity of having that backstop protection against system failures or unexpected events. Now, he does use stops, But interestingly, he often only places the stop order after the trade has already moved significantly in his favor.
Wait, why wait to place a stop? Doesn't that leave him exposed initially?
It seems counterintuitive, but it fits his specific style. Remember, he's trading these high volatility events.
Yeah.
The initial price action right after news can be incredibly wild and whippy. Placing a tight stop immediately could easily get him knocked out of a good trade just by random noise.
Ah, okay, so she relies on his own speed and conviction to cut the trade manually if it doesn't work right away.
Exactly. He has the ability and the discipline to liquidate instantly if the price action tells him his thesis is wrong in those first few moments. The formal stop loss, placed later once the trade is in profit, is primarily there as disaster protection, guarding against that catastrophic tail risk from a sudden reversal, unexpected secondary news, or another system failure. It's not for micromanaging the initial chaos.
Wow. Okay, so we've journeyed through 6 incredibly distinct, high-performing futures traders, and the range is amazing. You've got Brandt's rigid chart rules, Shapiro's deep contrarianism based on sentiment, Sal's laser-focused event sniping.
Netto blending fundamentals with tech for speed. Dhaliwal meticulously defining his macro edge, and Barg just hammering home the absolute priority of mindset. They're also different in how they operate day to day.
And yet, when you step back and synthesize their playbooks, these universal lessons start to emerge, don't they? Things that apply whether you're risking tiny amounts like Brandt or aiming for Sal's kind of explosive returns.
Absolutely. I think 3 core lessons really stand out across all 6 of them.
Okay, what's the first one? My guess is risk management.
Bingo. Lesson number 1, the absolute foundation. Risk management isn't just some feature you bolt onto a trading plan. It is the life support system for the entire operation.
The stop loss is king.
Paramount. Every single one of these traders, without exception, had their approach forged in the fire of devastating losses that came from bad or non-existent risk control. Shapiro blowing up accounts, Dhaliwal getting hit by that bad FT story without a stop, Sal's 24% loss from a computer glitch, Barg nearly self-destructing because he froze.
They all learned it the hard way.
They all learned the hard way, that classic maxim. Know where you're getting out before you even get in. That ability to take small, manageable losses consistently is the fundamental skill. It's what keeps them in the game long enough to catch the big winners.
Okay, universal lesson number 2.
Finding your fit. Success only seems to happen, or at least become sustainable, when the trading methodology aligns deeply with the trader's own unique personality, their psychology, their natural strengths and weaknesses.
That makes so much sense.
Think about it. Shapiro, he genuinely seems to enjoy arguing against the crowd. Being a contrarian fits his personality like a glove. It's not just a strategy, it's him.
Right.
Brandt, on the other hand, knows he can be impulsive. So he builds this incredibly rigid structure around himself specifically to counteract that tendency. His process neutralizes his personality flaw. You have to find a way of trading that resonates so deeply that you can actually stick with it, especially through the inevitable rough patches, those drawdowns we talked about.
If it doesn't fit you, you'll abandon it when it gets tough.
Exactly. Now, lesson number 3, the universal need to absolutely separate the outcome of a single trade from the quality of the process used. This is maybe the biggest difference between how pros think and how amateurs think.
Right, don't confuse luck with skill, or a bad outcome with a bad system.
Precisely. Barg learned that getting lucky on a trade didn't excuse his bad decision-making, his failure to act. Brandt defines a good trade purely by whether he followed his rules, win or lose. They understand that if you have a process with a proven edge over the long run, getting discouraged by 1 or 2 losses is a psychological trap. You have to execute the system faithfully, but, and this is the tricky part, you also have to constantly critically evaluate the system itself to know if your edge is genuinely fading or if the market has fundamentally changed.
That balance between unwavering discipline and execution and critical assessment of the strategy itself, that sounds like the real tightrope walk.
It's the ultimate nuance of sustained success, I think, that constant balancing act.
This whole deep dive, it really gives us an incredible set of tools for self-assessment, not just for trading, but really for any kind of high-performance field where you're dealing with uncertainty and need discipline.
I agree. And maybe if we leave the listener with one final thought to chew on, let's go back to Peter Brandt's fantastic motto, strong opinions, weakly held.
Oh, I love that one.
In a world drowning in information, much of it contradictory, not just in markets, but in life, how do you cultivate that necessary radical conviction in your plan, in your process? while simultaneously maintaining the critical, maybe even life-saving flexibility to admit you were wrong instantly the moment the facts or the price action clearly change.
That combination of deep conviction and profound humility.
Like duality.
Yeah.
It's perhaps the hardest lesson, but maybe the most valuable one these 6 market wizards have to teach us.
If you follow the financial news, you know the big names, the billionaires, the hedge fund stars, the kind of market gurus everyone talks about. But today, we're diving into something different.
Yeah, we're cracking open the playbooks of traders you've likely never heard of. These are folks who've compounded returns at, just spectacular rates.
We're talking 50%, 80%, sometimes well over 100% a year, for decades.
Right, for decades. And they've done it all while staying completely anonymous. It's kind of the ultimate paradox in finance, isn't it?
It really is. We're talking about traders who arguably have better track records than many Wall Street titans.
Exactly. And the sources we're using today, the insights from unknown market wizards, they really show that massive success isn't always about having huge capital or, fancy Ivy League degrees.
So what is it about them?
It seems to be about having a relentless, unique edge, often something highly customized, something that fits them perfectly, and then backing that edge with just ironclad discipline.
Okay, let's unpack this. So our mission for you today is a real deep dive into 5 of these, stock market anomalies. We want to pull out the core nuggets of wisdom from their unique methods.
And these methods are all over the map. Some are reading social media trends, others are using really complex systematic hedging. It's a fascinating range.
Our goal here is to give you the key insights, the actionable stuff, without you having to wade through hundreds of pages. Get straight to what drives this kind of extraordinary success.
And what's really striking is, like you said, none of these traders fit that classic Wall Street mold. Not at all.
Right. They found their success by looking where nobody else was looking.
Or by designing systems that perfectly manage their own psychological quirks and flaws. That's a huge part of it.
So today we'll dig into the specific edges of Jeffrey Newman, Chris Camillo, Marcin Parker, Michael Keane, and Pavel Krejci.
And then, crucially, we'll synthesize the common threads, especially the non-negotiable rules around risk management and trading psychology that seem to tie all these seemingly different approaches together.
Okay, let's jump in. Let's kick things off with a story that honestly sounds almost like a myth. Jeffrey Newman.
Right. Newman. Get this. He started with an account of just $7,700.
Tiny.
Tiny. And he compounded that at an average rate of 80% per year.
80%.
Per year. Over 17 years.
That's just staggering. And where did he do this? What market?
Penny stocks.
Penny stocks. Seriously. The place everyone says is just scams and pump and dumps.
That's the irony, isn't it?
Yep.
It's usually seen as this financial backwater,
Yeah.
Full of worthless companies and schemes. But Newman proves that even there, if you have a really well-defined edge and you stick to it religiously, you can get phenomenal results.
So what was his edge? How did he make that work?
His edge sounds deceptively simple. Being early.
Early. Okay. Howdy.
He applied this early idea through 2 different lenses, really. One was technical, the other was more observational, almost fundamental in a way.
Let's break down the technical side first. He wanted the absolute first sign of a shift.
Exactly. He was looking for the earliest possible technical signal that a stock was about to transition, specifically moving from a long, multi-year downtrend into what could be an explosive uptrend.
Multi-year downtrends? Like how long?
We're talking trend lines established over 1, 3, even 5 years. These are massive generational shifts in perception for a stock.
Okay. So he's looking for the bottom of these huge declines.
He wants to be the buyer right at the cusp of that critical breakout moment.
Mm-hmm.
He was super meticulous about his entry. He'd often try to place an order to buy the very last slice of a big sell order sitting there.
Like scooping up the last bit of supply.
Precisely. The example given is, say there's a 100,000 share offer at 31 cents. He might try to buy just the last 10,000 shares of that offer.
Okay, trying to catch that final moment of selling exhaustion. But you said his exit rule was incredible.
Incredible is one word for it. Maybe ruthless is better.
Yeah.
He had zero patience for being wrong. Absolutely none.
What does that mean in practice?
It means if the stock didn't follow through immediately after he bought it, he was out. Like, instantly.
How instantly?
The example is, if he buys at 30.1 cents and it ticks down to 30.0 cents, just one tick, he hits the bid, he's gone. Out.
Wow. That sounds It's psychologically impossible for most people.
Yeah.
How do you even make money if you're getting stopped out for a tenth of a cent loss?
That's the genius of it, though. It's about maximizing optionality and minimizing the cost of being wrong. Think about it. If a stock should be breaking out of a 5-year downtrend, the moment you buy, it should look strong. Right?
Yeah, you'd expect immediate confirmation.
Exactly. So if it immediately pulls back, even a tiny bit, that tells him his timing is off or maybe his read on the signal was wrong, by getting out for basically break even, maybe a tiny scratch loss, he preserves his capital.
And his mental energy too, I bet.
Absolutely. Keeps you ready for the next setup that does show that immediate follow-through. It's risk management disguised as an entry technique. It's brilliant.
That makes a lot of sense. The cost of that tiny loss is nothing compared to tying up capital and mind space in something that's just drifting sideways or bleeding slowly.
Yeah.
Okay, so that's the technical early. What about his observational edge? You said it was like Peter Lynch, but turbocharged.
Yeah, his ability to see a real-world event and reframe it into a massive market opportunity was just uncanny. Take the ethanol example.
Right, the ethanol stocks.
He made huge profits there. He read a local Kansas City news story, just a local piece about a bill proposing to increase the ethanol content in gasoline from 1% to 5%.
Okay, sounds minor. Wall Street probably wouldn't even blink at that.
Right. They might see it as, what, a 4% increase in the total gasoline mix? Marginal. But Neumann didn't see it that way at all.
How did he frame it?
He saw it as a 400% increase in demand for the ethanol industry. That reframing completely changed the significance.
Ah, focusing on the impact on the smaller industry, not the giant gasoline market.
Exactly. That immediately told him the market was completely mispricing the potential impact. He jumped in with massive conviction.
And when did he get out?
This is key. He liquidated his entire position on the very day the bill went to Congress, the day it hit peak media coverage.
Why then? Was that the top?
It was the point where his information edge disappeared. The moment the story became common knowledge, when everyone was talking about it, he knew his advantage, the information asymmetry was gone. The trade, for him, was over.
That idea of liquidating based on information parity when the secret is out seems crucial. It shows he wasn't trading the company's long-term prospects, just the information gap.
Totally. And his other research methods confirm this. The story about the CBD water stock is just perfect.
Oh yeah, tell us about that one.
He had a multi-million share position in the CBD water company. But he didn't rely on SEC filings or analyst reports to check on it.
What did he do?
He drove down to the largest beverage store in Texas, found the store manager, and just started asking simple, direct questions about how the product was actually selling, what customers thought.
Boots on the ground research.
Exactly. And the manager, just in casual conversation, dropped a hint, mentioned something about an impurity problem they were having with the water.
Something Wall Street analysts sitting in their offices would never find out.
No way. Neumann heard that, realized the implication, and sold his entire multi-million share position basically at the dead top, all based on a tip from a retail store manager.
That's incredible. He's seeing the market as real people, real products, real conversations.
Which leads perfectly into his famous golf course indicator. I love this one.
It really captures that behavioral finance aspect, doesn't it?
It's the ultimate contrarian signal, right?
Yeah.
He said he liquidated his crypto holdings and also his stake in that infamous sponge tech scam based on a simple observation.
Which was
When his non-investor friends, people who knew nothing about trading, started casually talking up these assets, like on the golf course or at dinner parties.
So when the hype reaches the absolute mainstream, the people who are usually last to the party.
Precisely. That casual chatter signals peak euphoria, peak emotional contagion. It means the trend has saturated the general public, and that's the perfect time to get out before the inevitable crash.
But how do you actually do that? How do you sell something that might still be rocketing up just based on what your dentist is talking about? That takes serious discipline.
It does. But remember, he's not trading price targets. He's trading information validation. His rule is, if the average person knows the secret is no longer valuable. It doesn't matter what the price chart looks like at that moment. It's an objective exit rule based on his edge.
Still, even with this discipline, he took a big hit early on.
Oh yeah, a huge one. Wiped out 30% of his account in a single day early in his career.
What happened?
He broke his own rules, got caught up in a good story about a stock that was soaring, bought it impulsively, emotionally, FOMO basically.
Fear of missing out.
Exactly. And the market instantly punished him, cost him a third of his capital. He said that loss burned the lesson into him for life.
Yeah.
Stick to your methodology, no matter what.
The moment emotion takes over, even the best lose their edge. Okay, let's shift gears to Chris Camillo. He kind of institutionalized this observational approach, didn't he? Build a whole system around it called social arbitrage.
Yeah, Camillo's approach is really unique. He calls it social arbitrage. And he's very clear it's neither fundamental nor technical analysis in the traditional sense.
So what is it?
He profits by spotting societal shifts, cultural trends, consumer behavior changes before they get reflected in the stock price. But he uses pure behavioral data, often from the real world or social media.
And he famously ignores all the standard Wall Street stuff.
Openly admits it. Doesn't look at price-to-earnings ratios, management teams, even price charts often. His entire focus is on the ground-level reality of how people are interacting with a product or a company, the conversational volume.
Before he built software for this, how did he get his edge?
Pure immersion. He'd physically put himself in the middle of pop culture, fashion trends, the kind of stuff that a typical analyst in a suit might completely miss or dismiss.
Like the Wendy's example.
The Wendy's pretzel bacon cheeseburger. That's his classic origin story. When Wendy's launched it, he didn't just read the press release.
What did he do, like Newman?
He drove around, visited about a dozen different Wendy's locations, talked to the managers, asked them point blank, how is this pretzel burger doing compared to other seasonal things you've launched?
And the answer?
The consistent feedback was, we've never seen anything like this before. That qualitative anecdotal data told him this wasn't just another LTO limited time offer. This was different, a cultural hit.
So he used that real-world feedback to bet that the market, which probably treated it like any other promotion, was wrong.
Exactly.
Right.
He saw the anomaly in demand that the market models couldn't see yet. That was the arbitrage.
And then he built software, ticker
Right.
tags, to scale this idea.
Right. Ticker tags let him monitor social media mentions, track conversational volume, the tags related to specific products, brands, companies. It let him do that Wendy-style research across the whole market, basically.
Okay, let's talk case studies. Netflix and Stranger Things. Analysts look at subscriber numbers, right? What did Camillo look at?
He looked at the conversation. Here's the key difference. Most hit TV shows, their social media buzz peaks in the first week or so, then drops off pretty quickly. Initial hype, then fade.
Makes sense.
Stranger Things didn't do that. The conversational volume plateaued. It held steady at a super high level, like triple the volume of the next most talked about show for over 60 days.
Wow. So it wasn't just a hit, it was sticking around in the culture.
Exactly. That sustained high-level conversation signaled a true cultural phenomenon, something that would drive long-term engagement and subscriber growth way beyond what a normal hit show would. And this insight flew directly in the face of some bearish analyst reports at the time that were focused on other metrics.
So it's the duration and intensity of the conversation that matters, not just the initial spike. He used this for shorting, too. The Chipotle E. coli situation.
Oh, yeah, that was a big one. When Chipotle had those health scares, Wall Street analysts were struggling to figure out the real impact on foot traffic. They were using lagged data, surveys, that kind of thing.
What did Camillo monitor?
He used ticker tags to track specific word combinations, things like Chipotle plus line or Chipotle plus lunch, Chipotle plus crowded. These are direct, real-time indicators of people actually going there.
And what did that data show?
It showed that those conversations dropped 50% overnight, a massive, immediate collapse.
Okay, but maybe it was temporary.
That was the crucial part analysts missed. Camillo kept monitoring, and those conversational levels never recovered. For a whole year, they stayed depressed.
A whole year?
Yeah. That proved the damage wasn't temporary fear. It was a fundamental, lasting shift in consumer behavior away from the brand. That allowed him to stay short the stock confidently, knowing the long-term earnings picture was much worse than the market realized.
That's powerful real-time insight. And more recently, he's using TikTok. How does that work?
It's pretty clever. When Crocs bought the shoe brand Hey Dudes, a lot of Wall Street analysts were scratching their heads, kind of mocking the deal. Didn't get it.
Didn't seem like a strategic fit to them.
Right. But Camillo used TikTok's own search bar. He started searching for Hey Dudes content and saw this huge, organic, almost cult-like following, especially among middle American consumers, a demographic maybe not on Wall Street's radar.
He saw the user-generated videos, the enthusiasm.
Exactly. The search velocity, the genuine obsession. It validated his thesis that Wall Street was blind to a real cultural trend and that the acquisition was actually brilliant, tapping into this passionate user base. The TikTok search bar became his mass validation tool.
It's like a digital version of his Wendy's drive around. Okay, let's talk about his exit rule. You mentioned Newman exited at peak media coverage. Camelo has a similar concept.
He does, and it's absolutely central to his whole philosophy. He calls it information parity.
Information parity, meaning?
Meaning he must sell his position the instant the specific information or trend he's trading on becomes widely known. The moment it hits mainstream news, it's picked up in sell-side analyst reports or just becomes common knowledge on the street.
Instantly, even if the stock is still going up, even if he's losing money on the trade.
Instantly. Doesn't matter if it's a winner or a loser. The second that information parity is reached, the trade is over for him.
Why so strict? Why not let winners run a bit more?
Because his entire edge is based on having that asymmetrical information, that unique insight nobody else has priced in yet. Once the information is public, that structural advantage disappears.
So the trade turns from having an edge into just speculation.
Precisely. By selling, the moment the edge evaporates, he avoids getting caught in that peak hype phase, which is often when volatility spikes and reversals happen. It ensures he gets out at or very near the point where his specific reason for being in the trade is no longer valid, just like Neumann using the golf course indicator.
It all comes back to rigorously defending the specific edge they identified, even if it looks weird to everyone else.
That's the core lesson from both of them, I think. Find your unique angle and stick to the rules that protect it.
Okay, so we've seen these observational, almost intuitive traders. Now let's pivot to the other side, the systematic traders. We'll start with Marston Parker. His record is incredible, 20 years, beating the S&P 500 significantly, averaging 20% a year versus less than 6% for the index.
Just a phenomenal long-term track record based purely on systems.
But here's the twist. His main advice, after all that success, don't quit your day job. That sounds odd.
It does, doesn't it? But I think it comes from a deep respect for how brutal the markets can be, even when you have a good system. It's about acknowledging the inherent volatility and the psychological pressure.
So his success wasn't about finding one holy grail system.
No, quite the opposite. His strength came from building a collection of different, relatively simple systems. Things like momentum strategies and, importantly, mean reversion strategies.
And the key was diversifying the systems themselves.
Exactly. He designed them specifically to be uncorrelated, or at least not highly correlated. The idea is that when one type of strategy is inevitably going through a tough patch, the other type might be doing well smoothing out the overall equity curve.
Okay, let's talk about his mean reversion systems. This is where things get a bit counterintuitive, especially around risk management. How do they work?
So a mean reversion strategy typically involves buying into weakness. You enter on a limit order when the market or a stock has dropped sharply, betting on a quick bounce back. Small, quick profits are the goal.
Right, the rubber band snapping back.
Exactly. But this leads to what's called the stop paradox.
The stop paradox? What's that?
Well, normally using a stop-loss order is trading 101, right? It's essential. But Parker argues that for a pure mean reversion system, a traditional price-based stop-loss cannot be used. Even a really wide one, like 20%.
Wait, no stop loss at all. How is that not financial suicide?
It sounds crazy, but think about the logic of the trade. You're buying because the price has fallen hard, because the rubber band is stretched. Now, what happens if the price falls another 20% and hits your stop loss?
It means it's fallen even harder.
Exactly. It means the market is now at an even more extreme point statistically. The rubber band is stretched even further. The very event that triggers your stop loss is actually the strongest possible confirmation that your original mean reversion idea should be more correct now, not less.
Ah, I see. The stop loss directly contradicts the reason you entered the trade in the first place.
Precisely. Using a price stop forces you to exit at the exact moment. The system's hypothesis should theoretically be strongest. It's a paradox. And it's why pure mean reversion trades carry that nasty tail risk if they fail to revert and just keep trending down.
Okay, so if he can't use a price stop to cut his losses, how on earth does he control that potentially massive risk?
He relies on two key things instead. First, a time stop.
A time stop.
Yeah. If the trade doesn't show a higher close within 5 trading days, meaning if that quick bounce back he expected doesn't happen pretty quickly, he gets out. He liquidates the position no matter the price.
So he's limiting the time risk, the risk of capital being tied up in something that's not working as expected.
Exactly. If the bounce isn't reasonably fast, the setup probably wasn't valid. The second control is rigorous position sizing.
Making sure the bets are small enough.
Critically small. He structures it so that even if a position went completely to zero, a 100% loss, however unlikely, it would not cause more than a 10% drawdown on his total trading capital. The small size is his ultimate protection against that tail risk inherent in not having a price stop.
Okay, that makes sense. Manage the risk through time and size, not price. But even with all this careful system design and diversification, Parker still got hammered in 2015-2016, a 45% drawdown.
Yeah, a brutal period for him, nearly career-ending for many systematic traders. He got hit by clusters of losses that his models didn't anticipate well, things like Chinese stocks collapsing, the biotech sector just cratering.
So his systems, particularly the momentum ones, just stopped working in that environment.
They really struggled. The market regime shifted to these sudden, sharp, sustained drops in whole sectors. And the huge lesson he took from that, echoing the famous trader Ed Seykota, was the importance of being willing to pivot, meaning recognizing that trading systems are infallible. They can, and sometimes do, lose their edge permanently as market conditions change. His survival depended on his willingness to radically change his approach.
What did he do?
He significantly shifted his capital away from the momentum strategies that were failing and towards his mean reversion strategies, which tend to do better in more volatile, choppy markets.
So clinging to a failing system, even one that worked for years, is a fatal trap. Flexibility is key, even for a systematic trader.
It's the ultimate systematic tool, perhaps. Knowing when the underlying assumptions of your model are no longer valid and having the discipline to change or turn it off, that requires humility, overcoming the ego tied to your proven system.
He also had some really sobering things to say about backtesting, right? His backtests showed amazing returns.
Yeah, this is a huge reality check for anyone building systems. His meticulously backtested models showed potential annual returns of 50%, even 100% sometimes.
And in reality,
trading lot.
he actually achieved about 20% per year. Still fantastic, obviously, but miles away from the backtest. Wow, so backtests always overstate things.
He argues they always overstate future performance, largely due to unavoidable optimization bias or curve fitting. His takeaway is you have to severely limit how much you optimize a system based on past data.
And use good data.
Absolutely critical.
Yeah.
Use clean data that's free of survivorship bias, meaning it includes all the companies that went bankrupt or got delisted, like the Enrons and WorldComs. If your data only includes the winners, your backtest results will be wildly inflated and unrealistic. He specifically mentioned Norgate data as a good source for this.
That gap between the simulation and reality is a really humbling lesson. Okay, let's move to Michael Keene. His approach seems less about individual systems and more about the overall portfolio architecture.
That's a good way to put it. Keene's core philosophy is about tackling the big problem in modern markets. High correlation. You know, the feeling that when the market tanks, everything tanks together.
Yeah, diversification doesn't always work when you need it most.
Exactly. So his solution is to deliberately construct a portfolio where different parts are uncorrelated, or even better, inversely correlated. The goal is that when one part of his portfolio, like his long stocks, is getting hit, another part, his trading strategies, should ideally be making money.
Okay, so how does he structure that in practice?
Typically, he runs about 60% of his capital in a long-term equity portfolio. That's the investment part, carrying the general market risk. The other 40% is dedicated to active trading strategies designed specifically to hedge or offset that long risk.
And what are those hedging strategies?
Mostly very short-term, short trades in the broader market and also some longer-term short positions, specifically in the biotech sector.
Biotech. Shorting biotech sounds like playing with fire. It's so volatile. What's his edge there?
It is volatile, but he has a very specific edge. He focuses on shorting biotech stocks around specific binary events like clinical trial results or FDA approval decisions.
Yeah.
He's not trying to be a scientist. He's trading predictable patterns in market behavior and statistics.
What kind of pattern?
He found, for instance, a compelling statistical pattern. Small biotech companies, say under $300 million market cap, that have a drug for cancer entering phase 3 trials. Historically, those trials have never succeeded.
Never. Wow.
Yeah, a stunningly high failure rate for that specific niche. So he's essentially betting against the market's often excessive optimism, betting on the historical failure rate, which is a statistically reliable edge in that context.
He's trading the odds, not the science story. Makes sense. But even a careful strategist like him must have learned about risk the hard way.
Oh, definitely. Like Neumann, his biggest risk management lesson came from a painful early mistake. He talked about shorting a stock that was going absolutely parabolic, just rocketing up. He did it impulsively, without a clear plan, and crucially, without a protective stop loss.
What happened?
It kept rocketing. Wiped out 10% of his entire portfolio on that one trade. A devastating hit.
Ouch. I bet that's why his risk limits are so tight now.
Absolutely. That experience burned the need for strict risk control into him. Now, he typically risks only 1% of his capital on those volatile biotech shorts, and even less, just 30 basis points, so 0.3% on his other less volatile short trades. It's almost always the biggest, dumbest loss that forces the most important risk rules.
But interestingly, his biggest psychological battle wasn't during a drawdown, but after a huge winning streak.
Yeah, this is such a critical insight about complacency. Keane had a fantastic year. He was up something like 35% late in the year. Performance was great.
So he should have been feeling good, confident.
Too confident, maybe. He fell into that classic trap. He started feeling like he'd earned the right to take more risk, to bend his own rules a bit because he was doing so well.
His success went to his head.
Seems like it. He abandoned his disciplined methodology and made an undisciplined trade, started buying energy stocks just because the sector had taken a big dive. It wasn't part of his core strategy at all.
What was the result of breaking his rules?
He gave back 7% of his hard-earned annual profits in just 2 weeks.
Wow. That's a painful lesson.
A super painful lesson about the danger of getting sloppy after success. High performance can breed this false sense of invulnerability, and that's exactly when the market tends to smack you down. Discipline needs to be tightest right after your best periods, not looser.
That's a fantastic warning. Okay, let's look at our final individual trader, Pavel Krajos. His story is amazing, the bellhop who beat the pros. His edge seems tied to overcoming a personal limitation.
Exactly. Krajos had a common issue, actually. He was really uncomfortable holding positions overnight. The gap risk, the uncertainty of what might happen when the market was closed, it just didn't suit his psychology.
A lot of traders feel that way, so what did he do?
Instead of fighting it, he embraced it. He developed a successful strategy that only involved very short-term trades, triggered by specific events that would last anywhere from just a few minutes to maybe a few hours, never overnight. He built a system around his comfort zone.
He calls himself a sniper. Right. Well, what does that imply about his trading?
It implies extreme patience and selectivity. He describes himself as being in a constant state of readiness, waiting for that perfect high-probability setup, the perfect shot. But he's not constantly firing.
He waits for the right moment.
He waits. He estimates that maybe 90% of the time, the market offers him absolutely nothing worth trading, according to his strict criteria, and that the vast majority of his profits, like 90%, come from that small 10% window when the perfect opportunity appears.
So most of the time, he's just watching, doing nothing. That must take incredible discipline.
Incredible mental discipline. To sit there potentially for hours or even days and resist the urge to take mediocre trades. He understands that chasing small random profits just wastes what he calls mental and financial capital.
It drains your focus and your funds for when the real opportunity shows up.
Exactly. His main edge, the kind of setup he waits for, is what he calls the contrarian event trade.
Okay, what does that mean?
It's a situation where the market initially reacts to some news event in what he perceives to be the wrong direction. The herd jumps one way based on a superficial reading, and he looks to trade against that initial emotional reaction.
Can you give an example, the ECB quantitative easing one?
That's the perfect example. The European Central Bank announced its big QE program, but the actual monthly purchase amount they announced was a little bit lower than some of the wildest market speculation had hoped for.
So the market was disappointed initially.
Yeah, the very short-term speculative money, the fast money, reacted instantly with disappointment. They sold off German government bonds, the Bund, and bought the euro, thinking, oh, the QE isn't as big as we thought.
But Krejci saw something else.
He looked past that headline number. He saw the real news was the ECB's open-ended commitment to QE. They said they'd do it for as long as necessary. He realized the initial sell-off in bonds and rally in the euro was just weak, speculative positioning based on a misunderstanding.
He figured those positions would have to unwind quickly once people digested the real meaning.
Precisely. He waited for that initial flurry of wrong-way reaction to stabilize a bit. Then he took his killer shot. He bet against that initial move, anticipating the market would soon realize the bigger picture of massive, open-ended easing. And he cleaned up over the next couple of hours as the market reversed.
So he's not trading the news itself, but the market's misinterpretation of the news, trading the transition from emotion to rationality.
That's a great way to put it. He trades the error in the immediate reaction. And his risk management reflects this high-conviction style.
How so?
He varies his risk per trade significantly, anywhere from 1% to maybe 5% of his capital, based purely on how strong his conviction is in that particular setup. He only puts the maximum risk on the line when he feels the setup is absolutely perfect, like the ECB trade.
And his stop-loss placement is a bit unusual, too.
Yeah, unlike traders who put their stop in the second they enter, Krejci often waits a moment after the initial price reaction to the news before placing a stop.
Why wait?
To avoid getting knocked out by the immediate chaotic whipsaw. That crazy, noisy price action that often happens in the first few seconds or minutes after a big news event. By waiting just a little, he lets the dust settle and places his stop based on a slightly more meaningful price level, not just the initial noise spike.
Smart. But he still needs a catastrophic failsafe, right?
Absolutely.
Yeah.
He has a hard circuit breaker based on his total account equity. If he hits a drawdown of 15% on his capital, he stops trading completely. Takes a mandatory break.
Forces himself away from the screen.
Yes. It's a crucial mechanism to prevent that downward spiral where a trader gets emotional after losses and starts revenge trading, digging the hole deeper. It enforces a cooling off period before the damage becomes irreversible.
Okay, so we've walked through 5 incredibly different traders. Norman reading penny stock charts and local news, Camillo analyzing TikTok, Parker building uncorrelated systems, Keenan shorting biotech based on stats, Krejci sniping event reactions. I mean, they seem worlds apart.
They really do on the surface. Different markets, different time frames, different tools. But when you start synthesizing the core lessons, the underlying principles, you find this amazing, profound overlap. It's quite striking.
What's the biggest commonality?
Without a doubt. Risk management is the core discipline. It's not just important, it's everything. And we get these chilling reminders from the sources, right? The absolute worst losses suffered by traders like Sal, Dhaliwal, Keenan, Hay, they almost all came down to one simple failure.
Failing to use a stop loss.
Failing to use one or failing to adhere to one they'd set. It's the fundamental sin.
But it's more than just put a stop somewhere, isn't it? The lesson seems deeper.
Much deeper. It's what we could call the stop mandate. Your stop loss must be placed at the price point that logically disproves your original reason for entering the trade. It shouldn't be based on how much money you're willing to lose or some arbitrary percentage.
So the trade idea itself dictates the stop level.
Exactly. And if that logically valid stop point represents more risk than you should be taking according to your money management rules, then the trade is simply too big. You have to reduce the position size until the risk fits. It forces discipline in sizing before the trade even goes on.
That's a powerful filter. And this risk focus extends beyond single trades to the whole portfolio.
Absolutely.
Okay.
Both Keene and another wizard, Shapiro, really hammered on the danger of high portfolio correlation. We talked about it with Keene, that risk that seemingly independent positions all start moving together, usually downwards, when the market gets stressed.
Right, the diversification illusion. So what's the practical fix?
Well, one key defense is simply reducing your overall market exposure, cutting position sizes across the board when you sense correlations are spiking. The other, as Keene demonstrated, is to actively seek out strategies or assets that are likely to be inversely correlated to your main holdings.
Like his long stocks versus his short biotech strategy, building in a natural hedge.
Precisely. You're deliberately preparing your portfolio for that scenario where everything goes down together, ensuring something is likely to zig when everything else zags.
We also saw the need for these hard and fast equity-based risk controls, like circuit breakers for the trader themselves.
Yeah, Dhaliwal's system, which we touched on, is a perfect blueprint for this kind of defensive architecture. His rules were purely mechanical, based on his account balance.
Remind us how that worked.
If his account drew down 5% from its peak, he had to cut his standard trading size in half. If the drawdown hit 8%, he had to cut size in half again. And if it reached 15%, he had to stop trading altogether for a period.
Taking the decision out of his hands when he's likely under stress.
Exactly. It removes emotion entirely from the process of managing a losing streak. It forces a timeout, prevents digging a deeper hole, and stops that human tendency to want to get it all back immediately by taking bigger risks. It's ultimate self-preservation.
There were even time-based rules, like Peter Brandt's Friday rule.
Yeah, that's a fascinating one. Brandt's rule was simple. Liquidate any trade that's showing an open loss as of the market close on Friday.
Why Friday specifically?
His logic was profound. The Friday closing price is the price at which the entire market is collectively agreeing to hold their positions and the associated risk over the entire weekend, when anything could happen, and they can't react. If your position is already losing money at that critical commitment point, it implies the market's outlook for that position over the weekend isn't good.
So holding that losing position over 2 non-trading days is just unnecessary, avoidable risk.
That was his view. It enforces prudence and avoids weekend gap risk on positions that are already proving problematic.
Okay, let's shift to the psychological lessons. Strategy is one thing, but the mindset seems just as crucial. What's a common psychological trap they highlighted?
A huge one is the danger of hope. Mark Sal emphasized this. He said the absolute sign you need to exit a losing trade immediately is when you catch yourself hoping it will turn around.
Hope isn't a strategy.
Hope is gambling, pure and simple. The moment your conviction in the trade's logic is gone and you're just relying on hope, you've lost your rational framework. You have to cut the position, no matter how big the loss feels at that moment.
This ties right into that conflict between wanting to be right your ego versus just wanting to make money.
Totally. As Amrit Dhaliwal put it, the market doesn't pay you for being intellectually correct. It only pays you for being profitable. So many smart people fail because they get attached to their thesis. They know they should be right even when the price is screaming they're wrong.
That ego, that need to be proven right, becomes a massive handicap.
A huge hindrance. Successful trading is about adapting to what the market is doing, not stubbornly insisting on what you think it should be doing. It's about making money, period, not about stroking your intellectual ego.
And then there's that universal warning we heard from Neumann, Keene, and Sal. Complacency kills. Their worst periods often came right after their best ones.
It's such a common pattern. You have a great run, make a lot of money, and you start to feel a bit invincible. Maybe you feel rich, maybe you feel smarter than the market. Or like Keene, you feel you've earned the right to relax your rules or take bigger chances.
And the market loves to punish that looseness.
Brutally efficient at it. That's when the sloppy mistakes creep in, the discipline wavers. The lesson is that the rigorous focus and discipline that got you the success needs to be doubled down on after a winning streak, not relaxed. That's when you're psychologically most vulnerable.
Finally, let's talk about patience and focus. Craigie and Sal talked about trading being like music. It's the space between the notes that matter.
Yeah, that space between the trades, that difficult period of waiting, watching, doing nothing, that's the real test. It's about having the discipline to avoid the marginal, low probability, maybe boring trades that just nibble away at your capital, and, just as importantly, your mental energy.
Saving your resources for the really good opportunities.
Exactly. They understood that trying to force trades when the market isn't offering clear signals only destabilizes you, financially and psychologically. It makes you less prepared, less sharp, when that truly high-conviction A+ setup finally arrives.
And there's also the patience needed within a good trade. Shapiro's lesson from his Africa trip.
Oh, that's a classic. Shapiro had a position on that turned into a massive winner while he was completely disconnected on vacation to Africa for several weeks. Couldn't check his quotes, couldn't tinker, couldn't panic out.
He was forced to be patient.
He was forced. And it taught him a critical lesson. His usual tendency, like most traders, was to watch his positions too closely, get nervous about giving back paper profits, and cut winning trades way too early. That forced disconnection showed him the immense power and profitability of just letting a fundamentally sound winning trade run until the reason for the trade is actually invalidated, not just because short-term noise makes you nervous. Patience to stay in is often harder than patience to get in.
Now, Jack Schwager himself, the author who interviewed all these wizards over decades, he obviously has a unique perspective. When he boils it all down, if he could only give one piece of advice, what does he land on?
It's incredibly simple, but he says it captures maybe 90% of effective risk management. It's a quote from another legendary trader, Bruce Kovner.
What's the quote?
Know where you will get out before you get in.
Know your exit before you enter. Why is that so powerful?
Because it forces objectivity. Before you put any money on the line, before you have skin in the game, you're thinking rationally. You can look at the chart or the fundamentals and clearly define, if X happens, my thesis is wrong and I need to exit.
But once the trade is on, emotion takes over.
Instantly. Hope, fear, greed, ego, they all cloud your judgment. You start rationalizing, hoping, bending the rules. By defining your exit point beforehand, based on logic, you create an objective rule that dictates the outcome, overriding the emotional noise that inevitably comes once your capital is at risk.
It pre-commits you to a rational decision. Okay, this ties into that age-old question. Do you need to be some kind of genius, have a super high IQ to be a great trader?
Schwager's answer is pretty clear. No, not necessarily. A high IQ certainly doesn't hurt, but it's absolutely not a prerequisite for success.
Why not? You'd think smarter people would do better.
Because many extremely brilliant people fail miserably in the markets. They're just as susceptible to all the emotional pitfalls, The fear of loss, the ego, the need to be right, the impatience, the greed as anyone else. Sometimes being too smart can even be a hindrance if it leads to overanalyzing or second-guessing.
So what's more important than raw IQ?
Finding a trading methodology that fits your specific personality and psychological makeup. Schwager gives the example of William Eckhart versus Tom Baldwin in the original Market Wizards book. One, a systematic genius, the other, an intuitive pit trader. Both massively successful, but their styles reflected who they were. Or Shapiro, whose naturally argumentative, contrarian personality was a perfect match for his contrarian trading style. It's about that fit.
That makes sense. The methodology has to align with your inherent strengths and weaknesses. And the ultimate synthesis of all this comes in the epilogue with the rabbi's parable.
Ah, yes, the parable. It's such a beautiful way to wrap up the whole concept. You have Dave, the index fund investor. He argues quite logically that markets are mostly efficient, most active managers fail to beat the index after fees, so the smartest thing for everyone to do is just buy and hold index funds.
And the rabbi listens and says,
You're right.
Okay. Then comes Sam, the successful trader, maybe one of these wizards. He argues, wait a minute, I make a great living trading. I consistently pull profits out of the market. It is possible to beat the market if you have skill and discipline.
And the rabbi listens to Sam and says,
You're right.
Exactly. So the bystander is confused. Rabbi, how can they both be right? Their arguments are completely opposite.
So how can they both be right?
The rabbi's punchline is brilliant. You are also right.
Oh.
Because Dave and Sam are essentially living in two different realities, defined by their own capabilities and approaches.
Explain that.
For the vast majority of people, the general public, who lack the specialized skill, the intense discipline, the personalized edge, and the ironclad risk management needed. Dave is absolutely right. For them, the market behaves as if it's efficient. Trying to actively trade is likely to lead to underperformance. Indexing is the rational, prudent path for most.
But the existence of these market wizards, the Sams of the world, proves the market isn't perfectly efficient for everyone.
Precisely. Their spectacular documented long-term track records prove that for a small minority, those with the right combination of innate talent, rigorous self-awareness, a demonstrable edge, and ruthless discipline outperformance is achievable. So Sam is also right, but only within the context of that highly skilled, dedicated few.
So the book's message isn't trading is easy, but rather trading success is incredibly hard, requires rare traits, but it's not strictly impossible if you approach it the right way.
That's it, exactly. It confirms that beating the market consistently is possible for some, while simultaneously validating that indexing is the correct path for most. It respects both realities. #tag outro.
Wow. Okay, so we've covered a lot of ground in this deep dive. We've mapped out 5 completely different roads to exceptional market success. You had the almost anthropological observation skills of Camillo, Newman's early bird technical precision in penny stocks.
Then Parker's flexible systematic approach, Keene's targeted hedging using biotech statistics, and Krejci's short-term event sniping. I mean, the actual systems couldn't be more different on the surface.
But underneath it all, that bedrock is the same, isn't it? Uncompromising risk control, and maybe even more importantly, deep self-awareness.
I think that's the biggest takeaway, connecting it all. If you look at the truly great advantage these unknown market wizards share, it isn't some magic ability to predict price moves. It's that unparalleled self-awareness.
Knowing themselves.
Knowing their strengths, knowing their weaknesses, understanding their own emotional triggers, knowing what kind of risks they could truly live with and survive psychologically. They tailored their entire approach, whether it was observational or systematic, to fit them.
Like Krejci building a whole system just because he hated holding overnight.
Exactly. He didn't try to force himself to be someone he wasn't. He built the system around his limitation and turned it into a strength. They stopped trying to copy someone else's perfect system and built one that was perfect for them.
So if we bring this back to you, the listener, what does this all really mean? If market success isn't necessarily about having the highest IQ or the most complex algorithm, but about finding a strategy that resonates with your unique personality, your natural ways of seeing the world, your biases.
And then, crucially, defending that personal strategy with simple, unflinching, non-negotiable risk rules.
Then the provocative thought to leave you with is this. What existing passion or natural curiosity or quirky observational skill or even statistical insight from your day job might you already possess? What unique way do you see the world that Wall Street misses? And could that kernel of an idea be transformed with ruthless discipline and risk control into your own bespoke, high-conviction trading edge?
Maybe that cultural anomaly you noticed last week, or that pattern you see in your industry data, Maybe that's the starting point. The real challenge inspired by the unknown market wizards isn't just to learn their methods, but to embark on the much harder journey of discovering and then rigorously defending the unique path that works specifically and only for you.